So let's look at a couple of examples. So let's try and understand how do we identify the correct journal entries for a particular scenario. So we'll take a scenario to understand this better, right? So purchase of assets for $1,000 from a vendor called as X and on credit. So we'll take a four-step approach to identify the right journal entries. The first step is to understand the scenario. What is the scenario? The scenario is purchasing of an asset for $1,000 and it is from X vendor and on credit. Okay, so this is the scenario. So what is step two? Step two is to identify the accounts impacted. The accounts impacted are asset and an individual called as X, who is the vendor. Okay, so here we are procuring something or purchasing an asset for credit and it is not on cash, so it's on credit. So there are two accounts impacted. One is asset account and then uh, the second account is the individual X who's the vendor. So step 3 is to identify for each account if it is a real, personal or nominal account. So for the accounts identified in step 2, we'll have to understand the nature of those accounts. So asset is a real account and individual X is a personal account. Okay. So step 4 is to apply the three golden rules of accounting. So real account, personal account and nominal account, and these are the three rules for the different type of accounts. So in this scenario, asset is a real account and we are purchasing an asset. So for real account, the rule is to debit what comes in. So since we are purchasing and some asset is coming in, we'll have to debit it. Okay. And the second account is an individual account and it is a personal account. So the rule for a personal account is credit the giver. Okay. So we are purchasing an asset from X and he is giving us a set of assets on credit. So the giver is to be credited. So individual X would be credited. So these are the two accounts and I've highlighted the rule which needs to be applied for this particular journal entry. So let's look at these four steps, and based on these four steps we have arrived at the journal entry, and the journal entry is as follows. So it will be asset account debit USD $1,000 and to X payable account $1,000 credit. Okay, and the narration would be being asset purchased on credit for USD 1,000 from X. So let's take one more example scenario to understand how we come up with the correct journal entry for any particular scenario. Okay. So the second scenario which we are taking now was cash sale of inventory for 1,100 US dollars and original value is 900 US dollars. Okay, so let's go step by step. Step 1 is to understand the scenario. So the scenario here is cash, there is a sale which is a cash sale of inventory and it is more than the original value. So there is a gain which is coming in. So that's the scenario. So step 2, identify the accounts impacted. So there's a cash sale, so there's cash involved. There's an inventory which is sold and there's a gain because we are selling it for more than the original value. So what is the step 3? The step 3 is for each of the accounts, let's identify the nature of the account, whether it is real, personal or nominal. For cash and inventory, these two are real accounts, and gains, it is to be considered as a nominal account. So step 4, as usual, we'll have to apply the three golden rules of accounting. So just to go back to the basics, real account, personal and nominal account. In this case, cash and inventory are real accounts. So cash is coming in. So we'll have to, as per the rule of real accounts, we'll have to debit what comes in, and inventory is going out. So we'll have to credit what goes out. And gains, it is a nominal account, and as per the rule, we'll have to credit all incomes and gain. So there are three accounts and two rules are getting applied, which is for real account and nominal accounts. And cash, since it is coming in, it is needs to be debited, and inventory, since it's going out as a sale, we have to credit inventory. And nominal account, uh, the gains we'll have to credit as per the rule. So what is the overall journal entry? The journal entry is cash debit 1100 for the full value of cash received, to inventory a credit of USD 900, which is the original USD value, to gain on sale of inventory, which is the actual gain, which is the differential between the original value and the cash sold value, the value of sales, which is 1100. So the net difference is the gain, which is $200. So we credit it to gain on sale of inventory. So let me just repeat. So it's cash debit 1100, to inventory 900, and to gain on sale of inventory 200. And the narration being cash sale of inventory for USD 1100 with a gain of USD 200.